Euro to US dollar macro view. The euro capitulation could be mostly attributed to a roaring US dollar strengthening across the board of late. Overnight, the Federal Open Market Committee, FOMC, meeting minutes showed a more hawkish board than the market had penciled in. The messaging from several Fed speakers over the past week has been a consistent mantra of keeping monetary policy tight for a long period. The minutes revealed that another hike might be in the offing if conditions warrant it. The 1- and 2-year part of the interest rate market scaled back rate cut prospects by around 10 to 15 basis points this week. Perhaps more importantly, further along the Treasury yield curve, there has been a parallel shift higher, underpinning the big dollar. The benchmark 10-year bond is trading near 4.29%, a whisker away from the 4.33% seen in October last year, which was the highest return on that note since 2007. How to trade euro to US dollar? The latest data on Treasury holdings for June revealed that China has been a consistent seller this year. The only month that they have been a buyer of US government bonds was in March when the yuan rallied significantly. This week, the yuan has been weakening and it's possible that China has again been selling US debt in order to sell USD and buy yuan. The market perception of the situation in the world's second-largest economy has deteriorated this week despite the People's Bank of China, PBOC, cutting its one-year medium-term lending facility rate to 2.50% from 2.65%. Country Garden and Sino-Ocean, two very large property developers, have defaulted on several offshore and onshore bonds this month. The concept of contagion entered the market's lexicon after Zhongguorong International Trust Co., a major player in China's trust sector, missed several obligations to its clients over the past week. If this scenario continues to play out, euro to US dollar could see further downside. Euro to US dollar daily technical analysis snapshot. Euro to US dollar remains below a descending trend line as it appears set for its fifth straight day of declines. If it was to rally and approach that trend line, there could be resistance at the 21 and 34-day simple moving averages, SMA. Potential resistance might also be offered in the 1.1065 to 1.1095 area where several historical breakpoints reside along with a recent high and just ahead of the psychological level at 1.1100. Further up, resistance could be at the breakpoint from the March 2022 high at 1.1185 or the recent peak at 1.1275, which coincides with two historical breakpoints. Above those levels, resistance might be at the Fibonacci extension of the move from 1.1095 to 1.0635 at 1.1380. Just above there are some more breakpoints in the 1.1385-95 area. Support could also be near the 78.6% Fibonacci retracement levels at 1.0770, which is just below the 200-day SMA. Ahead of that level, some prior lows and the breakpoint in the 10830-1.0835 area may provide support. The Australian dollar dropped against the US dollar after the Australian economy created fewer than expected jobs last month. The Australian economy created 14.6k jobs in July, compared with forecasts of 15k, well below 32.6k in June. The unemployment rate rose marginally to 3.7% compared with expectations of 3.6% versus 3.5% in June. Market has been strong with the unemployment rate hovering around 5-decade lows. Today's data could be an early sign that the jobs market could be cooling, lowering the bar for further tightening. The Reserve Bank of Australia, RBA, Governor Philip Lowe said Friday that the worst is over for inflation, though some further tightening might be needed. Markets are now showing a high chance that the cash rate will stay at 4.1% for a third month in September, but a small chance of another rate hike in November and stable rates thereafter for a year. In contrast, minutes of the June FOMC meeting showed most participants saw fighting inflation as their top priority, echoing San Francisco Fed President Mary Daly's remarks last week. There is more work to be done by policymakers. A resilient U.S. economy, further reinforced by this week's stronger-than-expected U.S. retail sales and industrial output, and a tight labor market has pushed up expectations for a November Fed rate hike. Higher for longer U.S. rates, the outperformance of the U.S. economy, and neutral speculative USD positioning point to continued support for the greenback. Furthermore, underwhelming China macro data have added to AUD woes. Data published earlier in the week showed retail sales, industrial output, and fixed asset investment came in below expectations, reflecting the trend in recent months. The China Economic Surprise Index is just of mid-2020 COVID levels. China is Australia's largest export destination. On technical charts, AUD-USD's fall below the June low of 0.6600 has triggered a double top pattern, the June and July highs, pointing to a drop toward 0.6300. For now, though, the pair looks deeply oversold on the daily charts as it tests a vital cushion on a downtrend line from early 2023.